The first research highlight from Daniel is the Purpose Core Dividend ETF.
Yeah, so this ETF is, we've had a lot of callers asking about just dividend strategies for Canada and the U.S. This one's unique because it combines Canada and the U.S. in a single exposure. So if you need income and you want a single ETF to give you exposure to both Canada and U.S. dividend payers, this is a way to do it. But it's also unique because it's part of the Purpose corporate class. It's not the highest yielding ETF in Canada. It's not even the cheapest in MER, although it's reasonable at, I think, something like 60 some basis points. But because it's part of the Purpose corporate class, it allows you to obtain at least partial exposure to U.S. dividends without receiving them as foreign income. It comes out of the mutual fund corporation that Purpose manages as Canadian eligible dividends. There may also be some capital gains depending on the tax year. And again, we're not tax experts, but it does something different from the other dividend funds in Canada. And for smaller accounts who need income and need a single way to get exposure to Canada and the U.S. in a tax-efficient way, this is a way to do it.
Your next research highlight, the Horizons Resolve Adaptive Asset Allocation ETF, HRAA.
That's right. This is a very complex product. Absolutely, requires some understanding as to how it works. It's very, very active, very quantitatively driven. In fact, it's kind of the combination of three internal quantitative strategies. Over at Resolve, they do global, long, short, macro. They do tail risk management. We think of this ETF as something that's appropriate as an alternative holding in a 60-40 portfolio. It's not kind of a standalone investment. It's there to provide some diversification. And as you can see, this year it behaved rather differently from the market, up significantly through the first half of the year while everything else was selling off and perhaps giving back some of those gains, but still flat on the year, which is, by itself, it doesn't look that attractive, but it's something that you would want to put in alongside a stock bond portfolio to add the diversification.
Did I see an MER there north of 2%?
You did, that's right. And in fact, that's because this is a hedge fund-like strategy. Again, not for everyone. There is a performance fee. So when it is above its high watermark, something like a 15% carried interest is applied, similar to a hedge fund. So there are other ETFs in Canada like that. In fact, other ETFs like HRA that we use as the alts in our portfolios, like HAC, a seasonal rotation ETF, or PMM, a market-neutral ETF. It's a growing category. There's a very popular one from Desjardins, DANC. So these are the kinds of products that you would want to stack against each other, understand how they work, learn their methodologies, see their fee structures, because they can be significantly more complicated than a typical ETF, which is, again, very cheap. These are significantly more expensive because of that carried interest.
And then the BMO Discount Bond Index ETF, ZDB.
That's right. So we talked a lot earlier about aggregate bonds, things like ZAG. So ZAG is, I think, the largest aggregate bond ETF in Canada now, very similar to XBB, the oldest aggregate bond ETF in Canada. It's been around for 22 years. The calendar year of 2022 has been the worst year for aggregate bonds since the inception of the first bond ETF in the world. What ZDB does is it basically gives you exposure to that kind of investment. All bonds in Canada that are investment grade across the maturity and credit spectrum, but it winnows down the universe a little more to get those bonds that have prices that are at a discount to par, or shall we say lower coupons, lower prices, so that over time, as you hold this ETF, it delivers the same kind of ag bond exposure to you, but in a more tax-efficient way, slightly more tax-efficient, because premium bonds that are high in price with high coupons trading well above their par values, those are very tax inefficient. They decline in price, and the capital gain credit you get is hardly enough to offset the prodigious income coming from the high coupons. So there's a lot of bonds that were at one time out there like that in the Canadian bond marketplace, and ZDB was a product that launched to address that issue.
I think I saw the MER was about 10 basis points.
That's right. So exactly right there, priced very, very competitively amongst the cheapest bond ETFs in Canada. So clearly positioned by BMO to be something that investors can use as a core allocation in their fixed income. And if they're not happy with the long duration, as we talked about before, you could mix in a shorter term version. There is a discount short-term bond ETF out there from BMO, or any other manner of cash-like floating rate or short-term bond ETFs.